All right, now we're going to get into another realm, so you can get a whole other look at causality. I'm saying this kind of causality doesn't work. The record shows it. The reason people believe it is because we've been programmed for tens of thousands of years to believe in mechanics, because we can get out of the way of a rolling rock, for example, if we understand mechanics. The problem is it doesn't work in finance. Now, what is socionomics? It's a difference in the way of looking at causality in a social context. The standard view of most papers in sociology, whether it's stated outright, which is rare, or assumed, which is usually the case, is that social actions motivate social mood. Now, what does that mean? It means actions that are taken socially will affect the way people feel. For example, if the economy is strong, that will make people feel better. They'll feel more optimistic. People think that's just a natural, how could it be otherwise? Or if a war begins, people will be more fearful, and they'll be, for example, might be angry as well. Socionomics says that's not right. It's our default, but it's wrong. But the actual causality is in the opposite direction. Social mood motivates social actions. In other words, that's where they come from in the first place. It's the mood that impels people to either make the economy better or worse, or be peaceful, or fight with each other. What is social mood? Social mood is an unconsciously shared motivational impulse arising from social interaction independently from events. Now, what does that word arising come from? A lot of people have a contagion model for the way people think. I don't think that works in socionomics. That's not the right one. It's just the same way that prosperity arises when people get together. Each person does his own thing that he's good at. He creates something, he works in a certain way, and he trades with his neighbors, and pretty soon everybody's a little better off. It arises from social interaction. Social mood is the same kind of thing. Now, it may seem frivolous at first thought, but this is a fundamentally different way of looking at the social world. In the top, we have some typical examples of the way people think, and at the bottom, we have examples of the way a socionomist would think. They're different. Let's look at the first line. A rising stock market makes people increasingly optimistic. That's the way most people believe. In fact, most technicians do. They say, yeah, as the market goes up, people are getting more optimistic. But we say no, first line at the bottom here, increasingly optimistic people make the stock market rise. That's why it's going up. Okay, let's look at the second line. Recession makes business people cautious. You'll hear that from economists from now until doomsday. But we think differently. We say cautious business people create the recession. That's where the recession comes from in the first place. Number 3 up there is war makes people fearful and angry. But we say it the opposite. Fearful and angry people make war. We'll skip to the bottom one here. Most people might feel upbeat entertainment makes people happy, and we would say no, happy people choose upbeat entertainment. So the causality is different every way we look at the world. The stock market we view as a meter of social mood. I'll give you one example of this. It's rather dramatic, and what I have here is a chart of the Dow Industrial Average divided by real money, which is the price of gold, just to emphasize what a dramatic change did occur in 1999. Now, on the left side of this line, we have rising stock values. We have 10 years of peace, relative peace around the world. Historical apologies among religions. It was really an amazing thing to witness. Presidents were popular. There was a housing boom. There was tolerance of immigrants. And there was corporate heroism. The leaders of corporations would be on the covers of Time magazine, Newsweek, and so on as heroes. And ever since then, we've had the opposite in all of these areas. We've had falling stock values, at least up to this graph, which ends in 2010. We had the Iraq War, terrorist attacks, religious conflict, low approval of president and Congress. Instead of a housing boom, we had a mortgage crisis. We had anti-immigration sentiment. They even passed laws to kick out the immigrants. And instead of corporate heroes, we had corporate scandals. Why are they all happening at the same time? One is not causing the other. They are all being pushed around by something else. Social mood is changing in the background, and that's making all of these things happen at the same time. Now, this is very important. This is key here, so listen up. Some actions that people take due to changes in social mood can be affected immediately. One of them is buying and selling stocks. So on the left-hand side, we've got a jagged representation of the stock market. This is aggregate changes in stock prices based on changes in social mood. When people's mood changes, they can make a decision to buy a stock or sell a stock instantly. They can call a broker, they can press a button. It can be done literally within seconds or minutes. And that's why we feel that the stock market is a very good representation of social mood, because it's an immediate responder to social mood. But there are other things that people do in response to social mood that don't show up immediately. Take, for example, a business person. He might decide, I'm feeling like it's time to expand my business. Now, suppose he makes that decision the very same day that an investor decides to buy stock. He cannot actually make his desire happen on one day. He has to meet with his colleagues. He might have to get with the bank and get a loan. He might have to go rent more space in the warehouses. He'll have to get his advertising people together and create a campaign. All this takes time. So economic changes, even though the decisions were made on the same day, are delayed by several months, because that's how long it takes for things to pan out, for all of his decisions to actually come into reality. The same thing is true of political actions. It takes a lot to get a political body moving. Even if people want to move on one day, they can't. They have to get together and they have to get everyone to agree, and they have to broker all their different things that they want until they finally reach a decision. So economic and political events tend to lag the stock market. Here's just a quick example. I remember the recent bear market of 2007 to 2009. It bottomed in March of 2009. Did the recession end at the same time or even before the low? No. It ended 3 months later in June 2009. Months after that, unemployment reached a 28-year high. There was a record low in new home sales months after the stock market bottom. And the Tea Party formed in the United States. That was a response to angry people at the low, but it took them months to actually coalesce and create groups and communicate with each other. All these are lagging effects of the very same social mood. So now we're going to look at some examples of socionomic causality. All the things that we just looked at that were no good in predicting the stock market, you're going to find the opposite causality is very reliable. Here's a 300-year history of stock prices. You'll see, generally speaking, that when stock prices go down for years or decades, that's when the wars break out. And it's true of all the major wars for the last 200 years. It goes back further than that, but this is our record. Notice that when stock price values tend to go up for several decades, relative peace is generally at hand. That's because this is a meter of social mood, and people are expressing those moods in other ways, including whether they're interacting peacefully with each other or deciding to bash each other's heads in. That's the power of long-term social mood tracking that we're showing here. This is even short-term. People say, well, okay, and the market was going up through most of the 90s, but there was a war. We had a thing called the Gulf War. So yes, it was a very small war related to the degree of the bear market that preceded it. This is a bear market from 1987 to 90 as expressed in the value line industrials. And as you can see, it was just weeks after that low that the US entered the Gulf War. The same thing is true of the Iraq War. Congress approved the Iraq War on the very bottom day of 2002. And the troops entered Iraq on the bottom week of 2003. That's when mood was negative. People were afraid. They were angry. They wanted revenge, and they wanted to check for, weapons that weren't there and all that kind of thing. These are responses to a negative trend in social mood. Now, we already saw that you can't use what party is elected to predict what the stock market will do. But the stock market is an awesome predictor of who's going to get reelected. The arrows at the top of this chart with numbers on them show you every time that an incumbent president of the United States was reelected. And in every case, there was a bull market going on. Why? People were in a good mood. The bull market reflects a positive trend in social mood. I'm feeling better. Why would I want to get rid of the president? People are crediting him with their good mood, so they keep him in office. The letters with the up arrows underneath are times when the incumbent was kicked out or lost power or left office. Because people are in a negative mood, they blame the leader for the way they feel. This is so reliable that we did a statistical paper on it. I'd urge you to read it because it's a great example using statistics to show that socionomic causality works, exogenous cause doesn't. Look at the bottom line there, SSRN, Social Science Research Network, has all of our papers posted, so you can get a look at those if you like. Now, of course, social mood affects not just politics and economics and the stock market, but just about everything in popular culture. So I could actually spend an hour here and show you chart after chart of changes in popular culture that reflect changes in social mood as represented by the stock market. I'm just going to show you one. We try to use other people's data as much as we can, so at least we eliminate the bias of data. People can still say, well, you're picking certain things, but we really haven't found a data series that we feel contradicts socionomic theory. This is a list we found on the web. Somebody put it together, and he listed the highest grossing film of every calendar year, going back 100 years. So we said, all right, let's find out. Most movies, especially popular movies, are positively themed. People like to feel good when they go to the theater, but on occasion, they're negatively themed. It's pretty rare, especially for the top grossing film of a particular year. So we went through and marked all the ones that are, say, horror movies, gangster movies, misery movies, people dying at the end, that sort of thing. And we plotted them against the stock market. And virtually all of them occur during bear market periods and at the lows. This is because people are expressing a negative social mood, not only in going to see the movie, but also in creating it. I think people tend to be more creative making a negative themed movie when they're in a bad mood. And so that's when they come out, that's when the good ones come out, and that's the ones that make a lot of money, because people actually want to go. People still make the other kinds of movies during bull markets, they just don't make much money. They're usually not as good either. In none of these cases does either variable control the other. A hidden variable, social mood, controls both. Most sociological studies are, does A cause B? You know, do elections affect the stock market? Does stock market affect elections? And our answer is neither one of them are right. If you try to figure out whether A is causing B, you will just spin your wheels and waste your time. C is causing both of them. That's why they're correlated. Okay. Now, based on what I've just said, you can see why the character of lagging social actions is highly predictable. The things that lag, such as the economy and politics, are predictable because you already know where the stock market's been going for the last few months. News, then, doesn't predict the stock market. The stock market predicts the news. This is why EMH is a complete failure. It says the news is pushing the stock market around. It's the opposite. Social mood is pushing the stock market around, and then it's creating news a few months later in terms of economics and politics. We have quite a few testable, falsifiable hypotheses in socionomics. In other words, it's not one of these things where anything works. We're making very specific claims. I'm just going to read the first one because we've talked about enough now so you can kind of understand where we're coming from. So here's our first claim here. Quote, preceding trends in the stock market predict election results, wars, peace, and the macroeconomy better than election results, wars, peace, and the macroeconomy predict ensuing trends in the stock market. And we've got plenty more such as this. We're making a very clear stand theoretically and through our hypotheses. We've already tested one, which is that paper on politics. I hope you get a look at it. And I would certainly welcome anybody who's an academic or who wants to help us with these studies because obviously manpower is something that we really need a lot of. Now, our institute publishes, I think, the coolest publication on the planet. And I don't write it, so I'm not promoting myself. These are my colleagues do this. It's called the Socionomics. And it takes mood trends that are in force and also ones we think that are likely to develop and says, here's what you can expect throughout the culture, throughout politics, and throughout the macroeconomy. It's really a lot of fun. Socionomics.net, you can find that there.